a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A deal potentially in the works. The US waiting on a response from Iran to the proposed plan that would gradually reopen the Strait of Hormuz. Optimism lifting stocks again today after back-to-back records. Brent crude also falling for a third day. And China's balancing act ahead of the Trump-Xi summit has regulators backtracking, telling banks now to pause new loans to US-sanctioned firms. All right, big evening around the markets. Let's get a check on what's been happening in the last few hours. Let's go to Alice French for the latest from Asia. Alice.
Morning. Yes, a nice up day here in Asia, mostly driven by Japan, which has had an explosive re-entry from its three-day Golden Week holiday. The Nikkei up again at another new high, mostly lifted by tech. Of course, Japan really factoring in those gains that we've seen in chips over the holiday. The offshore yuan as well having a good day, up at its strongest against the dollar since 2023. And if we look back at equities more closely, you know, like I say, that tech trend has really been driving the gains. SoftBank in Japan having a fantastic day, actually its biggest gain since 2020. Of course, we saw ARM overnight giving a pretty bullish AI outlook that's been helping sentiment. We do have earnings from SoftBank coming next week, and it'll be interesting to see how those investor worries about the kind of financial strain of its open AI bet play out.
Alice, thank you so much. That's Alice French there in Asia. Now to London for a look at what's been happening in Europe. Louise Moon is there for us. Louise?
Morning, Bonnie. So starting off with the stocks 600 for Europe, opening pretty flat this morning. There's obviously the focus is on geopolitics. A lot of caution there, whether or not that deal might come through. But one sector that is doing well is luxury. You can see this up higher. So that's the likes of Kering, LVMH, all those big luxury names, partly on the back of that potential deal, but also some strong Chinese consumer data coming through overnight, which is boosting that. And then a brief look at the euro US dollar, very slightly higher. Again, it's geopolitics focusing on that potential deal. But analysts saying, you know, there's room for that to move higher if that came through. But one other currency to really focus on is the Norwegian krone, the biggest macro story of the day. Norway hiking rates unexpectedly on the back of this inflation rise.
Central banks certainly reacting around the world. Louise, thank you so much. That's Louise Moon. It looks for now like we're headed for another day of oil declines and equity gains. We'll see if that tracks throughout the day. I liked what Paul Donovan of UBS said this morning. He said that it's blind faith that's driving pricing right now, and essentially the outcome of the war is in Iran's hands. Certainly the oil market, though, has priced in a decent reaction to that one-page memo that the US sent, with Brent crude still trading below $100 a barrel and WTI all the way down to 93. Fractional gains for S&P futures as well. It's been 7 days now that stocks and bonds have been moving in the same direction, and it looks like we might be in for another day of the same thing. The 10-year yield still down at 433.50 right now. I would point to the VIX, though. We're back at a 17 handle for what that's worth, and the dollar index seeing a little more weight to it once again. All right, it is time now to get some individual movers, and for that we'll go back over to London and Chloe Melly.
Good morning, Bonnie. ARM is a downer this morning after warning of weakness in the smartphone industry, which is really a key source of revenue for the company. And at the same time, it did say that really strong demand from AI data centers would help offset some of that slump. But we've seen shares essentially move up and down as investors try and decide what to focus on. But it seems that at the moment, they are very much focusing on the negatives, and we're down about 6% this morning. Moving on to DoorDash, which is up this morning. It is in the green after giving an order forecast that came in ahead of estimates. And so this shows really strong momentum in food delivery across those key markets for DoorDash, and we're up more than 10% this morning. And finally, Snap is down this morning in pre-market trading after saying that its advertising business had been really badly impacted by the war in the Middle East. It also has announced that it has officially ended its partnership with Perplexity. And so this is now raising questions about how that company is going to be able to compete within that AI space. And so we're down also more than 10% this morning for Snap.
All right, Chloe, thank you so much. Chloe Melly there in London. And coming up in this hour, we're going to catch up with Sitara Sundar of JPMorgan Private Bank. But first, the US waiting on Iran to respond to its proposal to potentially end the war eventually.
They want to make a deal badly, and we'll see if we get there. If we get there, they can't have nuclear weapons. You know, it's very simple. But what's not to submit. So they had a Navy with 159 ships, and now every ship is blown to pieces. Their leaders are all dead. So I think we won.
Joining us now from Dubai is Jumana Bersachi. Jumana, the oil market certainly seems to have decided that there is a path to reopening Hormuz. Are diplomatic channels wide open?
Well, that certainly appears to be the case. It's a different stance from where we were at the beginning of the week when, of course, there was concern that we may see another round of kinetic warfare, especially after those Iranian attacks that were directed towards the UAE. But what has become apparent in the last 24 hours is the U.S. really do want to go down this diplomatic route. And from what we understand, the U.S. presented a one-page memo, just a one-page memo with 14 points on it, to the Iranian side via the Pakistani mediators. Now, it has not been released to the public, but again, from our own reporting and other media outlets, we do understand that what it would entail would be an end to the war, an immediate end to the war, and then a 30-day period in which there would be negotiations around the eventual reopening of the Strait of Hormuz, the key sticking point, of course, negotiations around the nuclear file in exchange for the U.S. Lifting sanctions and unfreezing some Iranian assets. So very similar list of negotiation points that we had even before the war started, plus the extra one, of course, the Strait of Hormuz and what happens there. Our own colleagues from Bloomberg, according to sources that we've spoken to in Iran, are expecting a formal response to come through within the next 24 hours. So we'll see what their response is. So far, we've had a comment from the Iranian Foreign Ministry spokesperson who said that what the U.S. are pushing for is very maximalist. It reads more like a wish list. And so the big question here is whether you can bridge that divide once again between what the U.S. are pushing for and what Iran would like to see as well. A big question for markets. But ultimately, and I'll just use a phrase that I borrowed from RBC's Halima Croft this morning, for broader markets, and especially for oil markets, the question is, are we just going to get a ceasefire and ceasefire with a reopening or ceasefire without oil? And that is going to be the key question from this point, and whether we can actually move from this one-page memo to a situation where things start returning back to normal and there's significant progress on the nuclear file. There's still a tall order of items to get through.
All right, Jumana, we'll see what the response is. Jumana Bersachi there in Dubai. Global companies caught in the middle with conflicting signals from Washington and Beijing. Bloomberg learning that Chinese regulators have asked its banks to hit pause on the new loans to refiners that had been sanctioned by the U.S. over their ties to Iranian oil. This backtracking coming just ahead of the Trump-Xi summit scheduled for next week. Joining us now is Bloomberg's Denise Wee in Hong Kong. So, Denise, what is the latest guidance from China's financial regulators? It does seem to be a little bit of a backtracking, no?
Yeah, I mean, definitely it's a bit confusing here. We're seeing the financial regulators saying that the banks should pause new loans to these sanctioned companies. They should review their holdings and, not call existing loans, but also not make new loans to them. So this is quite contradictory to what we had a few days ago from the Ministry of Commerce, basically invoking the anti-sanctions blocking measure for the first time since 2021, and telling companies to basically ignore these U.S. sanctions, to just go ahead. It's not quite clear why there's this, confusing signals. But what's very clear is tension has been ratcheting up between U.S. and China ahead of the meeting. There's a lot of posturing. U.S. has been turning up the heat on Iranian oil shipments and warning the Chinese banks it could face secondary sanctions. And at the same time, China, invoking this blocking measure is clearly showing a signal they're not going to take things lying down. There will be consequences.
Now, Denise, China entities are getting involved legally with some American banks. So one particular oil trader suing JPMorgan and Citi. Give us the backstory here.
So basically this happened in February and March, so not so recently, but earlier this year, where a fuel trader has sued both the U.S. banks in Chinese courts in Beijing and Shanghai over quite small amounts, but they're suing the banks basically for freezing payment transfers, a company that was later sanctioned by OFAC. The company is basically arguing that they shouldn't have been frozen. This is discriminatory. This was done before the company was added to the OFAC list. It's kind of interesting because it's a rare move. We don't really see this too much, and it just goes to show the quandary that global banks face. They can't really, or even Chinese banks, they can't really flout OFAC's laws, but at the same time, they could face repercussions onshore.
Yes, and it's not just the banks, right? There are obvious challenges now facing global companies operating in China if you have competing regulations from the US and China that don't jibe.
Yeah, I mean, it's definitely become like so much more complex and harder to navigate the environment between these two superpowers that are having increasingly competing and conflicting laws. On the one hand, you've got Wall Street banks, which have billions at stake onshore. They've invested money, onshore, building businesses. On the other hand, you've got the Chinese banks that have dollar clearing licenses. They don't want to lose their access to dollars. So it's become very, very hard for banks to stay compliant, for financial firms to stay compliant in this difficult environment.
Changing by the day. Denise, thank you so much. That is Bloomberg's Denise Wee in Hong Kong. Now to other top stories trending on the terminal this morning. According to sources, Bank of England officials are privately concerned that positive UK economic data may be sending false signals, complicating their job of setting interest rates. Data since the pandemic show healthy economic growth in the first and second quarters before stalling or contracting in the third and fourth. The UK's National Statistics Agency will start publishing non-seasonally adjusted GDP figures to help provide additional context. The European Union failing to finalise a US trade deal. Negotiators from the European Parliament and EU countries met Wednesday to discuss potential amendments to the transatlantic deal initially struck in July. The EU is under pressure from the US to ratify the trade pact after President Trump threatened higher tariffs on autos. Bank of America analysts predict that France will win the FIFA World Cup this summer. Analysts believe France will face Spain in the final and will be led to victory by top scorer Kylian Mbappe. ARM Holdings out with a warning of weakness ahead in the smartphone industry. We'll talk about that next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Strong AI demand continuing to supplement income for tech firms. ARM Holdings falling in pre-market trading. It said that while they've seen a, quote, flip to negative in unit growth for smartphones, AI data center growth will more than offset the slump. Matt Bloxham of Bloomberg Intelligence joins us now. Thank God for AI, right, Matt? I mean, is it fair to say that ARM is going to do just fine now that it's producing its own chips as well?
I think that kind of certainly gives it some positive momentum, and obviously this smartphone market weakness, perhaps not that much of a surprise because we've been talking about constraints on memory chip supply, and essentially the supply there is going into the AI market, so that's definitely crimping, certainly the kind of mass market part of the smartphone market. But as you say, kind of AI demand is helping ARM revenues, and also got this new chip they're making themselves. And so when they first launched that back in March, they talked about an order book of $1 billion, and they're now talking about at least $2 billion of revenue over the next couple of financial years. So certainly some kind of good momentum there. And I think you obviously some share price weakness today, but you have to put that in the context of the massive ramp in the share price in 2026. I think it's pretty much doubled over the last few months. So I think, just perhaps a bit of profit taking there on the lack of an incremental positive surprise.
Yeah, not reading too much into this drop pre-market. Renee Haas saying, though, that the drop in the smartphone sales was primarily in the lower end of, the consumer rankings. I mean, should we be concerned? Is there something to be worried about there? Or is it just that consumers don't really need to upgrade and these phones are not that exciting, these new phones?
I think it's more probably about the inability of the market to actually manufacture enough of these low-end phones to put in people's hands. I think probably the underlying consumer demand is still there. I don't think there's been any big changes in the replacement cycle. It's just that the chips you need to put into these devices are going to other parts of the market, particularly AI and data centers, and where there is capacity and supply available for the smartphone market, it's going into the kind of more premium devices, and very much a kind of shift from volume to value amongst the big smartphone producers. Matt, we have to leave it there. Thank you so much, Matt Bloxham of Bloomberg Intelligence.
Another earnings mover we're keeping an eye on, Shell. Shares falling in Amsterdam despite a profit beat supported by higher oil prices. For more, let's bring in Bloomberg's Mitchell Furman. So Mitch, what happened with Shell in the quarter? Obviously the war would have helped in some areas.
Yeah, Shell, like many big oil and gas companies this quarter, saw higher profits on the back of higher oil and gas prices that were driven by the conflict. Shell has a large in-house trading operation, and its oil traders had a positive quarter. Shell did lose some volumes from the Middle East. It has a key Qatar business, and Qatar's volumes are offline as a result of missile strikes, and so Shell is going to need to get some volumes back. It's overall it lost 4% of oil and gas production compared to the fourth quarter.
All right, Mitch, thank you so much. We'll keep an eye on shares today. That's Mitchell Furman. Coming up, our conversation with BlackRock's Rick Rieder from the Milken Global Conference. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. As the Milken Global Conference drew to a close, BlackRock's Rick Rieder spoke to Bloomberg's Katie Greifeld and Romaine Bostick about the continued geopolitical risk in asset management. Have a listen.
The difference in the technicals in the equity market and the bond market are as diverse as you can imagine, in that we don't create enough stocks. We're, the buyback relative to the issuance of equities. People talk about the IPO market. It's tiny relative to the buyback market. We don't create enough equities, and there's a huge amount of cash out there. So you just get this continued buying, and then there's no stock. Now, if you have a bad piece of news, it can trend down for a day, a week. In bonds, we're getting $520 billion a week of gross supply of treasuries. There's no dearth of supply, so you have that. That is distinctly different. The other is we're witnessing a growth paradigm that is unbelievable. That is, I think this year you can grow 6% nominal GDP after a number of years of significantly positive nominal growth. And then you see this in the earnings numbers that are coming out. I've been pretty blown away by not just that you have top-line revenue that's impressive, but you have pricing power. Pricing power is the worst thing you can have for the bond market, because obviously what it means from inflation side. So I think it can persist. When we think about portfolio allocation, and I know we've gone through this, you still have a lot of danger out there in terms of geopolitical risk. But if you said, what's my convexity of upside, downside, if you know you're going to have either good news or bad news, and they're going to correlate together oftentimes,
right?
Like equities have a whole lot more upside than quite frankly, interest rates do today.
Yeah. We'll bring this conversation to the corporate credit market because, the point has been made that spreads, you've seen a little bit of widening, but, pessimists might say that looks complacent. But when it comes to the strength that we're still seeing through in corporate earnings, when it comes to equities, I have to imagine that translates to the performance of the credits as well.
So, it's pretty hard, and people say, I don't like these spreads at these levels. That being said, the yield fits portfolios, not just our portfolios, but with your pension fund, life insurance company, any insurance company, et cetera. The yields are very attractive because the risk-free rate is high because the central banks are keeping it there for inflation. So those yields are interesting. It keeps demand at a pretty at a great pace. The other thing that I think is significant is when you have, people talk about could you have defaults? People talk about private credit. There's stress in private credit. When the economy's growing at 6% nominal, or let's say I'm wrong and it grows at low to mid fives, it's pretty hard to have a default cycle of any significance. I've learned over my career, cash flow makes up for a lot of mistakes. And as long as you have that sort of backbone of cash flow growth, you're not going to have any significant default cycle.
BlackRock's Rick Rieder speaking there with Katie Greifeld and Romaine Bostick. Time now for your front page news. First up, the Wall Street Journal reporting jet fuel prices are spiking and President Trump's advisors are worried. The Journal says advisors are eager to end the war in the hopes that prices will begin moderating before November's midterms. Next up, the Financial Times reporting hedge funds are seeing their best monthly performance since 2020. This as managers profited from the rally in tech stocks. The FT cites data from HFR showing tech-focused funds saw gains of 14% over the month. Goldman Sachs research shows net leverage increased in April as managers bought more stocks than they sold. And finally, the New York Times on local elections in England today, a major test for Keir Starmer. His governing Labour Party expected to do very badly. Parliamentary elections are also taking place in Scotland and in Wales today. Let's take a look at your markets as we head into the Thursday session, and after days of gains for the S&P 500 hitting records 2 straight days. Futures pointed higher once again today as that narrative continues. The dollar index a little weaker once again. Yields also lower, though not by as much as yesterday, but we're still down another 1.5 basis points or so on the 10-year to 433.30. Needless to say, oil continues its decline. Brent is still below $100 a barrel. Coming up, Sitara Sundar of JPMorgan Private Bank, sticking with defense, industrials and semiconductors. She joins next. This is Bloomberg. It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A deal potentially in the works. The U.S. waiting on a response from Iran to its proposed plan that could gradually open the Strait of Hormuz. Optimism lifting stocks again today after back-to-back records. Brent also falling for a third day. And China's balancing act ahead of the Trump-Xi summit has regulators backtracking, telling banks now to pause new loans to U.S. sanctioned firms. So let's take a look at these markets. Maybe just a little bit more tentative today, but we are seeing futures point fractionally higher after 2 days of records basically across the indices. The S&P was up 1.5% yesterday. The Nasdaq was up 2.1%. And even the equal weight S&P set its first record since the start of the war. As you can see, Brent crude now below $99 a barrel. That is certainly helping. WTI below $93 a barrel. And if we look at yields, they're lower once again, but again by a lesser amount than the last few days. Nevertheless, stocks and bonds continue to go in the same direction as they have had the last 7 days. More weight to the dollar index, and the VIX is well above 17. I will say the odds of a permanent US-Iran peace deal by the end of the month are rising on Polymarket. We're talking about a 30% chance of that now. All right, for some stocks to watch, let's get to Chloe Melly in London. Chloe.
Good morning, Bonnie. ARM is in the red today after warning of sluggishness in the smartphone industry, which is a really important market for that company. It did say that some of that slump could be offset by very strong demand from AI data centers. But it seems that investors this morning are really focusing on that weakness in the smartphone market, and therefore we're down more than 6% in pre-market trading. Moving on to Whirlpool, which is also in the red this morning after cutting its revenue guidance. That really points to weak sales of household appliances, and that comes as the market is facing a very weak consumer sentiment, but also a subdued housing market in the US as well. And therefore, we are down more than 16% on the back of that guidance cut. And finally, Snap is also in the red this morning after saying that its advertising business had been really badly impacted by the war in Iran. It also announced that it had officially ended its partnership with Perplexity AI. And so that really raises questions about how Snap is going to be able to stand out in this increasingly competitive AI space. And therefore, we're down almost 10% in pre-market trading for Snap this morning.
All right, lots of moves there this morning. Chloe, thank you so much. That's Chloe Melly in London. I do want to let you know the Challenger job cuts are out, down 20.9% in April year over year. The total job cuts, 83,387, a little more than the 70,000 that was anticipated. Stock future is gaining then once again after back-to-back record highs. Let's get to JPMorgan Sitara Sundar weighing in on positioning for an offensive portfolio, writing, quote, "Lean into higher quality names that have sold off. We continue to like defense, industrials, semiconductors and utilities, all benefiting from the structural shift towards supply chain security and sovereign self-sufficiency." I'm pleased to say Sitara joins us now. She's head of alternative investment strategy at JPMorgan Private Bank. Does that still hold, Sitara? For how long can we see these gains and continue to subscribe to that viewpoint?
Look, it's the number one question. We've probably seen one of the fastest V-shaped recoveries in what still feels like an uncertain time. So there's a few things in times of uncertainty that we tend to anchor to, and that we tend to anchor to on what we know. And what we know coming into this year, which continues now, is that there are 3 structural and secular forces that are driving the market, likely for the next 6 to 12 months and beyond. artificial intelligence and the next phase of that, fragmentation and geopolitical fragmentation, economic nationalism, and what that's going to mean for the broadening definition of security outside of just traditional defense, to think about supply chain security, to think about energy security, and ultimately what those two forces are going to mean for inflation moving forward. So when we think about the market environment now, those three forces are still at play. There's a mix of offense and defense that, in terms of what that means for portfolios. But the biggest thing for us when we think about the next 6 to 12 months is that we're still constructive. And the primary reason for that is, at the end of the day, what we all know to be true from a principal perspective is that stocks trade on earnings growth. And this is going to be potentially the 6th consecutive quarter of double-digit earnings growth. And we haven't seen that since post the global financial crisis.
So assuming that's one portion of your thesis for your portfolio,
yes,
right? Then you're looking to do something else, something a little different. What is an uncorrelated asset these days?
Oh, it's the number one question, and I'm very happy that you asked that, because when we talk about artificial intelligence is buoying pretty much multiple parts of the equity market, both public and private. So when we think about areas of the market that can provide less correlated return streams, hedge funds is a big part of that conversation when you think about, especially within the relative value and macro space, which, depending on which manager you've been doing, have been doing their job so far this year on posting positive returns in periods of time, especially in March when stocks and bonds were down. And then two, finding areas of returns that are going to give you inflation resilient income. So real assets, when you think about infrastructure, when you think about core real estate that has had a pretty big valuation reset over the past couple of years, and we think that we're in the early stages of recovery, those pockets of the private markets and alternative assets is something that we're advising clients on outside of just gold in the commodity complex.
When it comes to the economy, how are you thinking about productivity going forward? I want to play a soundbite from Austin Goolsbee. Just let's have a listen to this.
Sure.
I want to ask you about productivity.
The productivity growth miracle is happening in an unexpected way, then it will mean lower inflation, and I think it means rates could go down.
So we know that Kevin Warsh thinks this as well, right? But the question is timing.
Correct.
Does it happen first, or do we see a bout of major inflation before we get to the productivity gains?
Look, I think that central banks, including the Fed, have a balancing act to play, and particularly within the Fed, on what's going to happen, on whether or not the potential disinflationary impact of artificial intelligence and what that means for productivity, at what time is that going to happen versus the potentially temporary, or if not temporary, impacts that higher oil prices and higher commodity prices are going to be. What we do know to be true is most likely we're going to enter an environment in which inflation is going to be structurally higher over the next 10 years than it has been over the past 10 years. And while we are constructive on the adoption rates within artificial intelligence and the potential productivity boosts, we are most likely going to see inflation structurally higher for the next, call it like 6 to 12 months. And then any kind of offset that we see to that would be longer term in nature.
So how are you seeing what the Fed is going to do next? Because that has implications across the board, across the curve, and particularly for private credit, which is obviously a very important space for you as well.
Right. So I think, in our opinion, the Fed is going to stay on hold for the foreseeable future. In terms of what that means for private credit, I think there's a couple of things. Right now, what we're seeing within the private credit market, I would venture to say that it's a normalization in the market. We're seeing a normalization from a flows perspective, and we're seeing a normalization from a returns perspective as well. We've been in an environment where over the past 3 years, direct lending specifically has outperformed high yield, it's outperformed lev loans, and a lot of that reason is because they're floating rate instruments, and when the Fed was hiking, the yields on many of those deals and ultimately securities went up alongside that. Now we're in a period of time where rates have normalized. The premium that we've seen within direct lending has been cut more or less in half versus other parts of extended credit. But the ultimate thing for us is that you need to be selective within this space. We have already started to see within the publicly traded BDC market, and we're starting to see it in the non-traded BDC market as well, dispersion in an ecosystem, because we're moving from a benign credit environment to a maturation in the credit environment, and that just means that manager selection is ultimately the name of the game here.
Sure. Sitara, given that that's your base case across the board, let's say, where are you looking for any potential reckoning? So, probably not going to happen, but could happen in this particular space.
Look, I think that the number one thing that we're focused on is thinking about where there are cracks underneath the surface. And one of the areas that we're focused very acutely on is the software sector, and not just within the equity space, but what that means for the lending side of the market as well, because we have started to see spreads blow out on the software side because of the potential of the application layer, agentic AI, vertical AI applications, and what that's going to mean for legacy software as a service areas. Now, our expectation is that we're likely going to see a tick up in software defaults and tech-oriented defaults. But the biggest thing for us is that we think that that's going to play out over the next 3 to 5 years. That being said, if there's anything that comes to fruition, that we start to see models get better, hallucination rates go down, we start to see adoption rates tick up, it's an area that we're watching really closely at this point, both on the equity side and on the credit side as well.
All right, Sitara, wonderful to have you in studio today. Thank you so much. That is Sitara Sundar of JPMorgan Private Bank. Now to other top stories trending on the terminal this morning. Germany's foreign minister says Chancellor Friedrich Merz and President Trump have solid relations and that Berlin supports the U.S. aim to ensure Iran cannot obtain a nuclear weapon. Johann Wadephul spoke with Bloomberg editor-in-chief John Micklethwaite in Berlin in an exclusive interview.
He was explaining to students in a school how the situation is, and of course that it is the attempt of Iran to humiliate the American president, and of course that there is a risk that some international observers could see it like this. So this was unfortunately really a misunderstanding.
According to federal prosecutors, lawyers from top M&A firms provided tips on some of their largest deals to an insider trading ring. 30 people were charged in federal court in Boston. Prosecutors did not identify the firms, but detailed descriptions of the deals indicate they included Wachtell Lipton, Rosecrans and Katz, Latham Watkins and Goodwin Procter. Bank of America analysts predict that France will win the FIFA World Cup this summer. Analysts believe France will face Spain in the final and will be led to victory by top scorer Kylian Mbappe. Coming up, Washington awaiting Tehran's response to its proposal to end the 10-week war. The latest on Iran next. This is Bloomberg.
They want to make a deal badly, and we'll see if we get there. If we get there, they can't have nuclear weapons. It's very simple. But what's not to submit? So they had a Navy with 159 ships, and now every ship is blown to pieces. Their leaders are all dead. So I think we won.
The U.S. now awaiting Iran's response to its one-page memorandum of understanding that includes plans to gradually reopen the Strait of Hormuz. Bloomberg's Jumana Bersechi is back with us from Dubai. So it's been about 24 hours. Jumana, do we know if there's been any movement on the Iranian side or if there's been discussions with mediators or anybody?
Yeah, well, what we do know is that the 14-point proposal, this is a one-page memo that the U.S. submitted to the mediator, Pakistan, has been passed on to Iran. So that's as far as we know. But there has not been an official response yet from the Iranian side. We understand, according to our own reporting, our Bloomberg colleagues, that the response should be coming within the next 24, probably 48 hours. And the question here is really, what does this memo actually entail? It has not been publicly released, but what we gather from our own reporting from other media outlets is it would entail an immediate end to the war and then a 30-day period in which they would discuss a gradual lifting of the mutual blockades around the Strait of Hormuz, address some of the thornier issues surrounding the nuclear file, including Iran's nuclear enrichment program, the fate of that highly enriched uranium stockpile, in addition to the U.S. agreeing to lift sanctions or potentially unfreeze some of those Iranian assets. So all of those are on the table once again, but it is a tall order to expect all of those items to be turned around in a 30-day time frame. And I think this morning we're walking in, and obviously oil is trading a little lower, as you can see, but there is some skepticism that over this 30-day period, you can actually solve all of the big issues on the agenda. Now, at the same time, what has become apparent, Vonnie, is over the course of this week, it's become clear that the U.S. administration wants to pursue the diplomatic avenue. Earlier in the week, there was speculation that maybe after the Iranian strikes on the UAE, the U.S. might go down the path of kinetic warfare once again. That has not happened. And we heard from General Kane earlier this week. He said that the threshold for going back to war has not been met again. So this is another diplomatic effort. But the same problems still remain, which is that the two sides are still very far apart on those fundamental issues. And Iran seem to want to maintain this key leverage point that they've acquired throughout the course of the war, which is their effective control of the Strait of Hormuz.
Meantime, President Trump is supposed to be still going to meet with Xi Jinping next week, and China getting a little more aggressive, urging the opening of Hormuz. Of course, Abbas Araghchi has just been there as well.
Absolutely. And so this also perhaps is being factored in to the accelerated timeline. And once again, President Trump has said that the Iranians are keen to do a deal. This is not the first time he said it throughout the course of these 70 days since the war started. And he seems to suggest that they could get something over the line in the next week or so. And of course, the clock is ticking. He's meant to be having that summit with President Xi Jinping towards the end of next week, which doesn't give them a lot of time. But from China's perspective, they also have an economic interest to get the strait fully reopened again and to get the free flowing of oil back to the region and to themselves. And they are the key buyer of Iranian oil. At the same time, the Iranian Foreign Minister Abbas Araghchi, as you said, was in Beijing yesterday. He met with his counterpart there. Once again, China reiterating that they want to see a diplomatic solution, diplomatic end to this. And from what we gather, there are many countries who are now looking to get involved diplomatically. It's not just Pakistan, China playing a role. And even in the Pakistani Prime Minister's post yesterday up on X, he also referenced Saudi Arabia looking to push the U.S. towards a diplomatic solution here.
Seemingly a concerted effort at this point. Jumana, thank you so much. That is Bloomberg's Jumana Bersachi in Dubai. Speaking of China, global firms getting caught in the middle with conflicting signals from regulators in Washington and Beijing. Bloomberg learning that Chinese regulators have asked its banks to hit pause now on new loans to refiners sanctioned by the US over their ties to Iranian oil. This coming just ahead of the Trump-Xi summit scheduled next week. Joining us now is Bloomberg's Nectar Gan in Hong Kong. So a directive that seems to be backtracking on a 5-day-old directive. Just bring us up to speed, Nectar. What exactly is happening?
Right. So China's financial regulator told the country's largest banks to review the exposure and business dealings with the 5 Chinese private oil refiners that have been recently sanctioned by the United States for processing Iranian oil. So the banks have been told specifically not to issue any new yuan-dominated credit to these refiners. And they've also been told not to call in the existing loans. So this is a verbal directive that delivered before China actually issued the blocking order telling companies not to comply with the U.S. sanctions. And as you point out, Vonnie, these messages look to be contradictory with each other. But I would note 2 things here. First of all, there's a time lag, right? So the financial regulatory's directive was delivered before China entered this long weekend holiday. And the Commerce Ministry's blocking order came during the holiday. And the second point is that these are instructions issued by 2 different government agencies. But it will be hard to imagine there has been no coordination at all within the Chinese government before they issued this blocking order, because this is the first time they've ever invoked it since the rules were introduced in 2021. So this is a pretty big deal. I think what it actually reflects is, the Chinese government is trying to perform a delicate balancing act here, because on one hand, they want to show that, they want to show defiance to the Trump administration, to U.S. sanctions. But on the other hand, they're also trying to protect China's biggest state-owned banks against, U.S. secondary sanctions. So they're trying to achieve both objectives here.
Yeah, confusing time indeed, particularly for global companies trying to operate there. Nectar, thank you so much. That's Bloomberg's Nectar Gan in Hong Kong. Let's turn back to earnings now. A slew of consumer and travel names set to report. Let's bring in Bloomberg consumer reporter Maddie Parker for more. So, everything from McDonald's to Expedia, Maddie, what will we hear about the US and international consumer?
Well, yes, so McDonald's obviously being the big one coming up. They're reporting first quarter results today, and obviously we'll keep in mind that DoorDash reported yesterday. They saw better than expected results. They saw their stock rally and topped analyst estimates. Really, all that focus will be for them on how they're performing with their customer base, and particularly with low-income consumers. Obviously, they're feeling the pinch already from higher gas prices, from inflation, and from weaker consumer sentiment across the board. Analysts generally still think that same-store sales might have risen this quarter, but we will keep in mind that McDonald's, of course, had to shut down some of its stores at the start of the year due to storms across the US, so that will be exciting. Other things to look out for, of course, Expedia, who are operating in quite a disrupted global travel market at the moment. They're a US-based platform, so people think that this quarter's revenue will still be pretty solid, but next quarter might be a little bit more tricky. And Airbnb, of course, who will be looking at how football or soccer fans are seeing the demand in advance of the World Cup in the US, Canada and Mexico.
Yeah, absolutely. We'll see if we can keep this trend of great earnings going. Maddie, thank you so much. That's Bloomberg's Maddie Parker. Coming up, we're going to get you set up for your trading day. More data and Fed speak on deck as well. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now look at what's ahead today. Earnings from McDonald's before the bell, and then CoreWeave and DraftKings among companies reporting after the market close. We get another round of initial jobless claims at 8:30 Eastern before Friday's non-farm payrolls. And don't miss our own Michael McKee's exclusive interview with San Francisco Fed President Mary Daly. That takes place at 12:30 Eastern. Couple of movers before the bell. Coherent, its revenue forecast beat estimates. Gross margins, though, underwhelming, and it's down about 3.5% in the pre-market. Fortinet jumping nearly 13% on an outlook hike following a billings expansion, the largest in 3 years. And DoorDash up 10%, extending gains after its order forecast topped estimates. This is your macro picture going into your Thursday session. We have crude continuing to fall, with Brent now below $99 a barrel. I want to point to the dollar index because it looks like it's a great picture in the last couple of days with stocks at records, but Bank Indonesia just out saying it's been all out trying to fight weakness in the rupiah, which has basically been weakening for months now. Fractionally higher on your S&P. That's it for Bloomberg Brief.